What's going on, everybody? Welcome to SRT Live with me, your host, Sean Richard. Does the Fed have it all together, and can they stop inflation from rampaging? That is what we're going to discuss today. Again, thanks so much for joining me. If you're watching in the Powerhouse Facebook group, welcome. If you're watching on the Powerhouse Real Estate YouTube channel, appreciate you being here as well. We've got a lot to unpack today. We've got an incredibly busy news week this week. Plus, we've got to cover some information from last week and take a look at what we all need to be watching going forward as we keep an eye on the pulse or a finger on the pulse of the real estate and economic markets. So let's go ahead and jump right in. Let's start with last week and some of the numbers. So as always on Thursdays, we get the initial jobless claims. We get jobless claims. These are individuals filing for unemployment. And we get initial claims, which is filings for the first time, and continuing claims, which are individuals renewing their unemployment benefits. So last week, and these are week over week numbers, last week, we had an expectation of 240,000 jobless claims, and we got 251,000. And that's an important mark because we've steadily been seeing the unemployment claims rise. If you recall from couple of months ago, we had hit some numbers week over week under 200,000, and so now we're above 250. Something to keep an eye on. Continuing claims also ticked up a little bit, going from an expectation of 1.34 million, climbed a little bit to 1.38 million. So up a little bit there as well. But some of the big news from last week was the ECB, the European Central Bank, was expected to increase the equivalent of the Fed funds rate, and it was expected that they were going to increase that 0.25%. They ended up increasing it 0.5%, which marks the first time they've done that in 11 years. And so that was a big deal over in Europe. And that just shows how serious they are about fighting inflation. That increase actually brought their Fed funds rate to 0, whereas we're currently sitting at 1.75. So they've been negative on their Fed funds rate for a long period of time, and just now getting to 0. But that's good news. The mortgage rate market liked that because it showed that other countries were serious about going after inflation on a global scale. So that way, it gave peace of mind that this is not just a battle that we're trying to fight here domestically. So looking at today, we got a plethora of information. In the housing market, we got the FHFA home price index. This is appreciation. We also got the Case-Shiller home price index. Both of these are home appreciation data. Case-Shiller is kind of like the gold standard. And so Case-Shiller, the previous month's reading, and let me say this. This is for the month of May. So the appreciation data is always a little bit lagging. So this is for the month of May. Case-Shiller, month over month, we got a 1.5% increase in home values for the month of May. So pretty staggering, despite the climbing interest rates, despite the real estate environment kind of slowing down just a bit. And then year over year, the expectation was 20.4, and we came in at 20.5%. The previous reading was 21.2% year over year appreciation. So we've slowed down a little bit, but by golly, still at 20+% appreciation year over year. But we want to keep an eye on that going forward because this is definitely something that's likely to trim down a little bit. We also got FHFA, Federal Housing Finance Agency, also an appreciation report. Month over month, we got a 1.4% reading versus the expectation of 1%. So we actually blew past the expectation from analysts at a 1.4% appreciation rate month over month. And the year over year number came in at 18.3%. So both of these reports showing that housing market as of May still robust from an appreciation standpoint. We also got June new home sales as well. And the expectation that was an annualized pace of 660,000 sales, and that missed the mark. That came in at 590,000 annualized pace new home sales, new construction, and that was down 8% from the previous month. So we are seeing a little bit of a slowing. I still don't think we're seeing a complete shift, and I'll talk about that more in a minute with some great data that you can take to your clients. If you're a homeowner, a home buyer, some great information that you can keep an eye on. Some additional data that we got. We also got earnings from Walmart, and you might say, "Well, Sean, what's the importance of the earnings from Walmart in the real estate market and the economy?" Well, here's the importance. Did you know Walmart employs 1% of the entire country's workforce? That's right. 1% of the entire country's workforce is employed by Walmart, about 1.6 million people. Unbelievable. So the impact of Walmart's earnings is that as such a significant employer, the how Walmart goes a lot of times gives us a really good indicator of what the country is doing. So Walmart missed on sales expectations, also downgraded forward-looking guidance, and that just is more details and data to point to a slowing economy, despite some of what we hear from our leadership saying that a recession is not likely. I'm going to have to disagree with those that are touting that line. All right, so let's look ahead to what we've got coming up this week, because again, big week. So tomorrow, we've got the Fed funds rate decision. The Fed started their meeting for July today. They finish that up tomorrow. We are expecting a Fed funds increase of 0.75%, bringing our Fed funds rate to 2.5%. Now, if you're a saver and you've got money in the bank, in a savings account, then you're going to benefit from that because you're likely going to see your bank increase your savings rates. If you've got a lot of credit card debt or you've got a lot of other discretionary debt, you might see those interest rates tick up because of a Fed funds increase. But very important to understand that mortgage rates are not adversely affected by Fed funds increases. The Fed funds rate is the short-term overnight bank-to-bank lending rate, and it is a short-term rate, whereas mortgage rates are long-term rates. The Fed increasing the Fed funds rate is designed to combat inflation, which is the enemy of mortgage rates. So if inflation starts to come down, we're likely to see mortgage rates come down as well. So the Fed funds rate increase has the ability to, over time, help bring mortgage rates down. Don't be confused what the mainstream media is touting or what you read on the headlines. You're going to see a lot of misinformation. That's definitely not the case. We're also getting pending home sales this week as well. So that's going to be existing homes not sold yet. And this is going to give us a state of the housing industry as well. That's tomorrow. Thursday, really important numbers. We get the first or the initial reading of Q2 GDP. If you recall, Q1 GDP final reading came in at a negative 1.6% growth, and the Q2 reading is expected to come out at negative growth as well. So what does that mean? Well, technically, the old school technical definition of a recession is 2 consecutive quarters of negative GDP. So if we get a negative GDP reading on Thursday, technically, we're in a recession already. Now, the government, the economic powers that be, are likely not to call a recession. We're going to get a total of 3 readings on the GDP. We're going to get one this month, we're going to get one in August, and we're going to get one in September. So we'll see where that final reading comes out in September. And the government has been coming out and stating that they're not using the old school technical definition of a recession anymore. I think we can all feel what's going on in the economy and our pockets and our when we go to spend at the store and at the gas pump. So that's on Thursday. And then Friday, we get the Fed's favorite measure of inflation, PCE. That's personal consumption expenditure. And so that's coming out on Friday. All right. So big questions. What do we want to keep an eye on? What are we looking at going forward to help us give us a better idea of the pulse of not only economy, but also the housing market? So number one is, let's talk about recession. Everybody's talking about recession. Is it coming? Is it not coming? The government likes to say that it's not. We're not going to have one, but a lot of indicators point to we are going to have one. So let's watch the indicators. Let's watch jobless claims. One of the major indicators of recession is when unemployment bottoms out and starts to tick back up. So jobless claims are a great indicator of that. And we've seen jobless claims rise over the past several months. Let's keep an eye to see if it continues that trend. Second is continued economic slowdown. We've heard a lot of companies come out and report earnings with a miss and stated that advertising is slow, sales are slow, and that's slowing growth. If that continues to be the case as we continue through earnings season, then that's another great indicator that we are likely headed towards a recession. Now, quick note, a recession is not all bad. Although during a recession, there's a lot of negative aspects of it, a lot of job loss. Typically, you've got lower incomes. You've got, in this case, with high inflation, we've got more cost at our spending, grocery store, pump, gas pump, things like that. But during a recession, two critical things happen in the mortgage industry and the real estate industry. One, home prices tend to continue to rise, and interest rates tend to come down. So that's going to be a great boon for anybody that's buying right now. They're going to get the benefit of increased appreciation or continued appreciation, as well as a opportunity to refinance at a reduced interest rate. Right. So second thing, number one is recession. Number two, inflation. The Fed rate hikes, how are they taking effect? When are we going to start seeing the short-term Fed funds rate hikes take effect on our long-term mortgage rates and overall inflation? The Fed funds rate increases are designed to, again, combat inflation by basically destroying demand. By limiting demand, the supply has the ability to catch up to the demand and therefore bring inflation down. So when are we going to start seeing that take effect? We've got another Fed funds rate hike tomorrow. And then watching inflation reports like PCE, personal consumption expenditure, CPI, which is consumer price index, watching those trends as those come out on a month over month basis to see if that inflation number starts to come down. Have we peaked with inflation yet? A lot of people believe we have, but the reports are going to tell us. And then the third thing that we want to watch going forward is our housing market. We want to look at the strength of demand. Although we're seeing a softening in a lot of areas of the country, we're still seeing demand really, really high. If you saw some of the numbers I posted a couple of weeks ago, majority of the country is still seeing upwards of 70% of housing sell within a 2-week span. Some areas and some specific houses are going slower than that, but in general, demand has stayed relatively strong. And then the second part of that housing is inventory levels. What are we seeing with inventory levels? We've seen at the beginning of summer here, end of May to now, that inventories have ticked up some. And that's because we tend to see that during these months. End of school, early summer, people tend to prepare and start to list their homes. And a lot of times we see inventory tick up a little bit. With the amount of demand that's come off the table due to rising interest rates and increasing home prices, we're the demand coming down a little bit is making the supply increase look even more appetizing than it might otherwise do so. So the softening market is a great opportunity for buyers to hop back in. If you're a real estate agent, you should be telling this to your buyers right now. I'm not a huge fan of saying the market has shifted, but I do think that we are seeing a softening in the market. And if you're a home buyer and you've been sitting on the sidelines, now is the perfect opportunity for you to jump back in. Interest rates have come back down a little bit and demand has waned and home prices will continue to rise. So getting in on the ground floor to build that equity, really important. They say, when is the best time to build a tree? Well, the number one time is 20 years ago. The second best time is today, because 20 years from now, that tree is going to be grown. Same thing with buying houses. All right. And the last thing I want to show you before we get going here, let me pull this up. Actually, let me do a quick check in our group to see if there's any questions or comments that I need to address. All right. Well, that's coming up. Let me go ahead and pull this up. Okay. So let's share this for you. Boom. All right. Kind of in the way here. Tell you what, let me do this. Let me hide this for just a minute. So we've got new home sales on signed contracts on new homes. And this is really important because I want to talk about inventory. And so you can see here that we talked about new home sales. We got 590,000 annualized pace. So we've got that right here. The total inventory on new homes is 457,000. So if we turn this 590 into a 12 and into a monthly pace, that's 49.2, and we divide it into our total inventory, we've got about 9.3 months of supply in the market. But hang tight, because not all of these 457,000 homes are actually available and ready to move in. These are pending construction, stuck in supply chain delays. So actual completed homes of that 457 are about 41,000. So a little bit shy of 10%. So now if we look at our monthly pace and divide that into our available inventory, complete and ready to move into within the next 30 to 60 days, we are actually still sitting at less than a month of new home inventory nationwide. And so inventory is still down. We've seen it pick up a little bit, but we are still in a lower inventory environment. And so, still a great time to be a seller, but it's becoming a better time to be a buyer than we've seen over the last 6 months. So I wanted to point that out. And you may note here the median home price dropped from 444 to 402. Just a note on that, that's the median price. Half the homes sold above that, half the homes sold below that. So if we've got buyers that are starting to look at lower price points due to maybe stretching their budget at where they would like to be, then buying lower price points are going to push that median home price down. All right. Gang, that is all that I have for you today. Thank you so much for joining me on this episode of SRT Live. Again, I am your host, Sean Richard, with the Sean Richard Mortgage Team here at Guaranteed Rate. If you'd like to talk about the economy, the housing market, don't hesitate to hit me up in the comments below or my contact information here. Would love to help you and your clients get into that new home so that way you can start building equity today. Reach out and my team would be happy to help out. All right. Thank you and have an incredible rest of your Tuesday. Bye.